Welcome to the Hurst Trading Room. This is our video update for the 18th of March 2013. The markets are in a very interesting state at the moment. I believe that most of the markets that we watch and that we trade are in the process of turning, which is always a fairly volatile time in the markets, and so we need to be very careful with what we're doing. We need to make absolutely sure that the analysis that we are basing our trading decisions upon is as good as it can be. And so let's take a look at the markets. Before we do, of course, please make sure that you have read and understood these disclaimers. First of all, here is a chart of the S&P 500, and this analysis is probably looking fairly familiar to you by now, but let's just speak about some of the details here. First of all, of course, I'm working with an analysis that places the 18-month cycle trough in the middle of November. And then we had a very clear cycle, very nice clear cycle action into the 40-day cycle trough, which was at the end of December. That clear and simple cycle shape implied that we had a 20-week dominant cycle, which meant that we expected a subtle or difficult to identify trough of the 80-day cycle, which, as you can see, possibly occurred on the 4th of February, or at least in the first week of February, but it's very difficult to say for certain because it is indeed a very subtle trough, possibly a hidden trough. The other thing that the 20-week dominant cycle implies, let me just write that here, the 20-week dominant cycle, the other thing that implies is that often the subtle 80-day cycle trough will be followed by a straddled 40-day cycle trough, and indeed that is what I was thinking was occurring around about this time, and that this is possibly a trough of the 40-day cycle. As you can see in this analysis, it actually places a 20-day cycle trough there, but we'll speak a little bit more about that in a moment. Then, of course, price bounced up, and if this was to be a genuine straddled 40-day cycle trough, the price action should be fairly symmetrical. As I mentioned last week, the price action has, of course, extended to the upside, and it's not very symmetrical. I wouldn't really call that a symmetrical price action. And so we need to ask ourselves whether this is really what is unfolding, or is this possibly something else that's unfolding here. Let's just run with this train of thought for the moment. If indeed this is going to turn out to be a straddled 40-day trough, and it's not yet impossible, we might look back and say, oh, well, that was a straddled 40-day cycle trough. If it is, then, of course, we will expect price to come further down here. And the interaction that we're seeing now between price and the FLD is, in fact, an F category interaction. And therefore, of course, we should be entering into a short trade on the basis of this analysis as price crosses below that FLD. Now, an interesting thing happened this morning, and that is that prices overnight opened up well below that FLD. If we zoom in a little bit, you can see here, I'm recording this in about the middle of the day on Monday, Central European time. The American markets haven't yet opened, but as you can see, there was a lot of price action overnight well below the FLD, and so price has so far crossed down below the FLD. I say so far because the median price needs to be below the FLD for a price cross to be confirmed. And of course, we haven't had this day's trading yet. It's not impossible that the price could go up even higher, and our median price will end up above the FLD, in which case there hasn't been an FLD cross. Now, why didn't I enter a short trade overnight? I never enter any trades over a weekend, or certainly on a Sunday night, the overnight trading before the market opens, and that is because there is often a lot of volatility following a weekend. And today is no exception. There has been a great deal of volatility in most markets today. And so I almost always step back from the markets a little bit on a Monday, which is why I record these videos on a Monday, because it gives me a chance to step back and take a look at what's happening, let the market settle into the week, and then generally start entering into trades on a Tuesday. I rarely enter into trades on a Monday. Now, so that's what happened. Of course, price so far looks as though it has crossed down below the FLD. Ironically, of course, it happened over a weekend. Reminds me of what happened over New Year. If we go back to have a look at what happened over New Year, of course, there was a big price cross over the FLD. Here is the FLD, and there was a big price cross over the FLD on New Year's Day. So that was a trading opportunity that we missed. And of course, it's possible that this is a trading opportunity that we have also missed because the price cross occurred over a weekend, although it looks as if the price has bounced back up to the FLD. And so we might not yet have missed this trading opportunity. And so according to this analysis, it would certainly seem that we should be entering into an F category short trade. But now I've already pointed out that this trough here is possibly only a trough of the 20-day cycle, and therefore, the analysis story that I've been painting isn't entirely correct. And if that should in fact be a 40-day cycle, then it isn't looking very straddled. And by which I mean the price action surrounding that trough isn't looking very symmetrical. And so it's possible that that is not the scenario that is playing out. I must tell you, I continue to believe that that is what is playing out, and the reason for that has to do with other markets. And we'll take a look at the Nasdaq in a moment, and I'll demonstrate to you how in the Nasdaq this scenario seems to be making sense. But of course, the other alternative is provided to us by the analysis information presented at the foot of the chart. Here, as you can see, is the circle and whiskers for the 20-week cycle trough, and that is right below this trough at the end of February. And so it is very possible that this was a trough of the 20-week cycle. So let's take a look at a chart which shows that trough as a trough of the 20-week cycle and see how that would affect our trading decisions. Here is a chart in which I've influenced the analysis, and I have placed the 80-day cycle trough, as you can see over here. Nevertheless, Sentient Trader is very reluctant to place the 20-week cycle trough over here under the trough at the end of February. And that's a little bit of a warning sign to me, because I trust what Sentient Trader does, and when it is reluctant to position a trough there, I know that there must be a reason. Of course, the reason has to do with this very tricky price movement over here, where price was limited to a very narrow range of, or at least a very narrow band, an upwardly sloping band. And so the identification of the troughs in that band is very difficult. Nevertheless, we can see that it is possible, certainly, that the 20-week cycle trough did occur at the end of February. And I've counted the number of bars since then. There have been 21. That would mean that we're expecting the formation of the first 20-day cycle trough to form after that 20-week cycle trough, in which case, of course, we would be expecting a B to C category interaction. And so let's zoom in a little bit and speak about potentially trading that BC category interaction. Here we go. Now, a B category interaction, of course, is when price moves back down towards the FLD. And I spoke about this last week. I was speaking about how this could potentially be a category B interaction between price and the FLD. And that is usually followed, of course, by a C category interaction where price pulls up away from the FLD. So B is as price moves down towards the FLD, and C is as it breaks up and away from it. Now, is what we're seeing today an extension of the category BC interaction? Well, that's not impossible. It could be that price is simply tracking along the FLD for another few days and it's going to break to the upside again. But what we have already seen over here looks to me like a fairly good and reasonable BC category interaction. And so I would be cautious about investing my money or trading on the basis that we're still going to see a category C interaction. And so combining that fact with the fact that Sentient Trader is very reluctant to position this 20-week cycle trough over here, I would certainly be very cautious about entering into a long C category trade. I would certainly stay well clear of it. I would watch what was happening today. Of course, on a Monday, I would not enter within the price range of Friday's trading anyway. And so I would certainly not enter into a long C category trade today. Certainly within Friday's range. If price came all the way back up to here, then I would consider entering into a long C category trade. But I would rather let the price action unfold for the duration of today and then see where price took us later in the week. And certainly a potential entry level into a C category long trade would be at the level of last Friday's high. That would be a very sensible place to enter into a potential C category trade. If price was to fall down a little bit below the FLD, then of course we might be provided with an entry level by the FLD itself. But you need to be very careful of the fact that this might not be a C category interaction, but might in fact be a G category interaction. So let's take a look at the Nasdaq, where we can explore that idea a little further. Here is the chart of the Nasdaq, which matches the analysis that we've just been speaking about in the S&P 500. There is the 18-month cycle trough in the middle of November. There is the 80-day cycle trough at the end of 2012. And here is the 20-week cycle trough at the end of February. And as you can see here, there have been 20 days since that 20-week cycle trough. And last week, of course, I was expecting a category B and then C interaction between price and the FLD, and in fact I set entry levels at the level of the FLD on the hopes of getting into a C category long trade last week. In fact, price never came up to the FLD, and so I was not stopped into my long C category trade. And as you can see today, price opened sharply below the level of the FLD, and it has spent the rest of the overnight trading session climbing back up again. So to my mind, of course, one has to ask whether this still looks like a category B interaction, which would be followed by a category C interaction. And I've got to say it's not looking very good and very clean. For the whole of last week it looked good because price was tracking along the FLD effectively. It was staying close to the FLD, and if price had broken up sharply, then we would have entered into a C category trade and hoped to profit from the move upwards. At the moment, price has dropped down below that FLD quite hard, and it's not looking very good anymore as a potential C category long trade. And so I believe it's probably time to start questioning this analysis to make sure that we haven't missed anything in terms of what is happening in the analysis. So let's ask a few questions about this analysis. One of the things that is immediately apparent about the analysis is that this 20-week cycle trough is very, very early indeed. It occurred at about 102 bars, I believe. So 102 bars is very early for a 20-week cycle trough. So it is possible that that, in fact, is not the correct placement for that 20-week cycle trough. So let's take a look at an alternative analysis. The first thing that I always do when I start exploring alternate analyses is I get rid of all my pins. I stop influencing Sentient Trader, and I simply get Sentient Trader to do what it wants to do. And this is the analysis that it comes back with. And that places, as you can see, of course, the 18-month cycle trough in the middle of November, which I'm not questioning at the moment. 80-day cycle trough over here at the end of 2012. 40-day cycle trough over here. And then this trough at the end of February, this very prominent trough over here, it has positioned as a 20-day cycle trough. Now, is this a possible analysis? yes, it's possible. To my mind, it's not a very good analysis, and one of the most obvious reasons why it's not a very good analysis is because the most prominent trough in the past almost 3 months is a trough of only 20-day magnitude, as you can see over there. So when you have a really prominent trough that is phased as a very small cycle, as the trough of a very small cycle, then of course that raises question marks. So one of the obvious questions to ask here is whether the analysis that I've been writing about in the weekend blog and the analysis that I've been looking at in the S&P 500, whether in fact that analysis is possible in the Nasdaq. And so let's just quickly speak through that. That analysis identifies the fact that there is a clearly dominant cycle because of this very clear, neat cycle over here. And the dominant cycle is generally a cycle of about 4 times the length of this first simple cycle, which means that you expect a subtle or hidden or perhaps straddled trough for the next cycle. And so is it possible that this cycle trough over here is in fact only the 40-day cycle trough? That's what I would ask, in which case we possibly saw a hidden trough of the 80-day cycle. Now there are many potential positions for that hidden cycle trough, so it could be any one of those. So is it possible that one of those is a trough of the 80-day cycle? And then what we saw after that was the formation of a straddled 40-day cycle trough, which is what I was expecting, what I have been expecting in the US markets, and therefore this is another trough of the 40-day cycle. Is that possible? Well, we can test that premise very simply in Sentient Trader, and what I'm going to do is I'm going to move this 80-day cycle trough and I'm going to pin it to one of these trough positions over here. Let's choose that one, and let's see whether that is in fact a possible analysis. There we go. Sentient Trader has completed the analysis, and as you can see, it now labels or phases this trough over here at the end of 2012 as a trough of only 40-day magnitude, and this 80-day cycle trough is a very subtle trough, as you can see, which is what we would expect, given that here again we have a 20-week dominant cycle. What do we expect following that hidden 80-day cycle trough over there? Well, I would expect often to see a straddled 40-day cycle trough. Have we seen that? Yes, we have. That is looking fairly symmetrical. Of course, price came up a little bit higher 2 weeks ago. It's not perfectly symmetrical, but it is fairly symmetrical. So this is definitely a possible analysis. Let's have a look at the FLD and price interaction sequence, which of course we trade, and see whether that sheds any light on whether this analysis could be true. The first interaction that we would expect would be an A category interaction. Is that a good or typical A category interaction? No, it's not. So I'm going to put a cross there. Then, of course, we expect a BC category interaction. Does that look like a typical BC category interaction? Yes, it does, actually. So I'm going to write B and C there. Then we expect a D category interaction as price comes down into the 40-day cycle trough over there. And then an E category interaction as price pulls back up from that 40-day cycle trough, and then of course an F category interaction as price breaks down below the FLD. So this looks fairly reasonable, I must say, and as you know, it's the situation we've been tracking in the S&P 500, and so what should we be in at the moment? Well, probably an F category short trade. Of course, there's a lot of volatility in the markets at the moment, and we missed getting into an F category short trade because the cross effectively happened last week, and as you know, this wasn't a category trade that I was thinking of trading at the time, and it's possible that we've missed this opportunity, although as you can see, price has today bounced back up again. So what's happening today? Well, following an F category interaction between price and FLD. We expect price to bounce back to the FLD and come up to the FLD and probably track along it for a few days in what is a G category interaction, and then of course we have our H category interaction as price moves down again. And so this is a very viable interpretation of what's happening in the Nasdaq at the moment, and very possibly in the S&P 500 as well. And so I am certainly not going to jump into an F category trade now, because we've missed it. As you can see, the target generated from that peak over there through the price cross over there was in fact very accurately achieved in overnight trading this morning. So that target has been achieved, that target is fulfilled, that move is over. It happened unfortunately over the weekend, or in overnight trading, and so we've missed that particular trade. But when price comes back up to this FLD, I will not be going long in the Nasdaq, because I suspect that it might be a G category interaction, and I will be watching for an opportunity to get into an H category short trade instead. Let's take a look at the euro to US dollar. In the euro to US dollar, last week I mentioned that we might have the opportunity for a quick H category trade as price finally moved down into the 40-week cycle trough, which of course we're expecting. And in fact, that H category short trading opportunity wasn't presented to us, and I'll zoom in a moment and speak about that in a little more detail about why we weren't presented with that opportunity. And what would be our next opportunity? Well, of course, we need to watch the markets very carefully and determine whether, in fact, this is the expected 40-week cycle trough that is forming in the market. If it is, then, of course, our next trading opportunity is an A category long trade as price bounces out of that 40-week cycle trough. Now, this is, of course, one of the analyses that I've been following, what I call the short cycles analysis, because of the very short 80-day cycle which elapsed between mid-November and the first week of January of this year. And so this is my short cycle analysis, and in terms of determining whether, in fact, that 40-week cycle trough is likely to be forming at the moment in the market, we need to have a look at how many bars have elapsed, and also consider what else might be happening in the market at the moment. As you can see, there have been 125 bars since the most recent 20-week cycle trough, which is in the middle of November. And so we expect about another 11 bars, so possibly another week and a half before that cycle trough actually forms. Since the most recent 80-day cycle trough over there in the first week of 2013, there have been 73 bars. So in fact, that trough is now due. And what about since the most recent 40-day cycle trough? Well, here, of course, we begin to have a few question marks really next to the position of these troughs, because the identification of these troughs has been fairly tricky. There have been 38 bars, it would seem, since the most recent 40-day cycle trough. That is assuming that that really is, of course, the 40-day cycle trough over there. And there have been 17 bars since the most recent 20-day cycle trough, assuming that that is the most recent 20-day cycle trough. So certainly, according to this analysis, the time is ripe, and the 40-week cycle trough should be forming right now in the markets. Let's take a look at the other possible analysis, which I've been calling the long cycle analysis, which stretches out these cycles a little bit. And here, as you can see, I have the 20-week cycle trough in the middle of November. That trough is common between the two analyses. And I've pinned the 80-day cycle trough over here, and that indicates that there have been 38 bars since that 80-day cycle trough. What does that mean? It means most probably that, in fact, what's forming in the markets at the moment is a 40-day cycle trough, and that we have to sit through another 40-day cycle before the 40-week cycle trough actually forms in the market. So that is what's happening in the euro to US dollar. And according to the first analysis that we were looking at a moment ago, of course, I would enter into a long category A trade. According to this analysis, we would be considering a long E category trade. Now, they are both long trades, and we enter both of those trades on the basis of price crossing the FLD. And so what will I be doing in the euro to US dollar? I will be entering into a long trade at the level of the 20-day FLD. Having entered into the long trade, having got into the market, we can look back and we can say, well, clearly that was only a 40-day trough, or perhaps that was clearly the trough of the 40-week cycle that we have been expecting. As a matter of interest, there's a lot of news about what's happening in Europe at the moment. There often is a lot of news about what's happening in Europe at the moment, but things are looking perhaps more dire than ever in Europe, and many people would take that as a sign that one should stay well clear of the euro currency, perhaps. In fact, I'm a bit of a contrarianist, and I believe that when the news is really bad, one is often surprised by the fact that markets bounce out of troughs at about that time. So I'm not letting the news influence my trading decisions. My trading decisions are made on the basis of the FLD trading strategy, and as long as I have my analysis correct, then I know I will make profitable trading decisions. Now, before we take a look at the British pound to US dollar, let's speak about why the H category trading opportunity did not present itself last week. Let's zoom in a little bit here and take a close look at what actually did happen in the markets. Now, last week I mentioned that price had come up to the FLD in what was probably a G category interaction, and that an H category would be expected next when price broke down below the FLD. The first thing to observe about what happened last week is that for the entire week last week, price tracked along the FLD. Can you see that? Each and every day of last week, the high was above the FLD and the low was below the FLD. That is absolute textbook tracking along the FLD, and so price tracks along the FLD between your G and H category interactions, and so we never actually got our H category interaction when price broke away from that FLD. It's quite possible that that happened over the weekend, and that our H category interaction happened over the weekend. That is possible. Of course, we missed it because we weren't trading over the weekend. What if you had last week set an entry level at the low of the week before, which was a sensible entry level into an H category trade? You still would not have entered into that H category trade. And it's very important that you understand this, particularly if you found yourself doing this last week. Remember that our targets for our trades are generated on the basis of price crossing down through the FLD. And so here was the previous high, all right, in the first week of March, and here was the level of the FLD all week. All right, so perhaps on this day, on Wednesday, when price was mostly below the FLD, you could have looked back and you could have said, okay, well, price crossed the FLD at that level over there. And here was our initial stop loss. So that's our initial stop loss. That's our crossing price. Now, my entry price would have been below the low of the previous week, which is way down over here. I'm not drawing very straight lines, but that's the entry price over there. Where is the target for this trade? From the initial stop loss down to the crossing point and an equal distance below, our target is about over here. That's in fact our T2 target, our target for the full trade. And our entry price, as you can see, is more than halfway down to that target. And so that is a situation that we don't trade. When our entry price is beyond our T1 target, which is halfway there, then in fact we don't enter into that trade. And so we didn't get a clear H category trading opportunity in the euro to US dollar, and so we wouldn't have entered that trade. Of course, if markets were open 7 days a week, then quite possibly over the weekend we just might have had an opportunity, but it still seems very unlikely. Of course, price might come down for another week or even another 2 weeks before actually forming the trough that we're expecting, and then bounce up again. But that might prove to be a missed opportunity. But remember, there are trading opportunities all the time in the markets, so we don't need to scrabble around and find poor trading opportunities. And this was a poor trading opportunity that simply didn't manifest. We're going to wait for the good trading opportunities, the profitable trading opportunities. Let's take a look at the British pound to US dollar. Now, the British pound to US dollar is also approaching a very important turning point, a turning point of probably at least 18-month magnitude, possibly even longer, possibly even 54 months. And so, because it is approaching such an important turning point, we've got to be very careful about getting into the market prematurely, because as you know, we can often encounter double GH interactions, potentially even triple GH interactions, and so we've got to be careful of price coming up to the FLD and then bouncing down again, as has happened already on 2 or possibly even 3 occasions in the British pound to US dollar. And so when we're approaching a really big turn like this, and we have to be cautious about it, the first thing that I always do is take a step back and just take a look at the analysis, and let's see how many bars have elapsed. First of all, how many bars have elapsed since the 18-month cycle trough? There have been 529. Which means we expect about another 17 bars. That's about 2 weeks. So we're certainly approaching the perfect time for the 18-month cycle trough to form, and you can see that from this circle and whiskers over here. There it is. That's the ideal time for that 18-month cycle trough to form. It certainly could form now. It might have formed last week. It's very, very possible. What about timing from the most recent 40-week cycle trough, which is over here, of course? There have been 290 bars. So, in fact, that trough is now overdue. So, we're expecting it to form any time now. So, certainly time is ripe. What about the most recent 20-week cycle trough? That was over here. And you can see these are all very nice, clear and obvious cycle troughs in the market. There isn't much question about the positioning of these troughs. There have been 124 bars, so to be absolutely perfect, and the markets aren't always absolutely perfect, but to be absolutely perfect, we would expect another 12 bars to lapse. And so here we had 17 bars. So certainly we're expecting this trough to form fairly soon. It might even have formed last week. So let's take a good look at what happened last week, and I'm going to speak about why I didn't enter into the market last week, but why we might be entering into the market this week. First of all, you'll notice that in my discussion about the recent cycle troughs, I didn't bother discussing how many bars there have been since the most recent 80-day cycle trough. That's because this trough happened in a steeply falling market, and it was a hidden trough. It was a very difficult trough to identify, and so a bar count from here would be unreliable, to say the least. That 80-day cycle trough might have occurred over here, might have occurred here, here, could have occurred afterwards. So a bar count from that trough is fairly meaningless. So that's why I haven't bothered counting the number of bars since that trough. So what happened last week? Well, let's zoom in even slightly further and take a good close look. As you can see, last week a potential trough formed, and Sentient Trader has in fact positioned question marks below this trough, indicating that might be a trough, the trough that we are expecting, the really long-term trough. And as you can see, price bounced back towards the FLD, and a very interesting thing happened on Thursday. I'm drawing over that FLD, and price came right up to that little peak in the FLD. Now, when I see that happening, I know that one has to be very careful, because very often price will come up to the FLD, and perhaps even sort of get onto the FLD, straddle it slightly, and then it will fail again and it will drop downwards. So if we were automatons performing this trading process, then we wouldn't have entered into a trade on the Thursday. The FLD on Friday was down at this level over here, and we would have entered at the level of Thursday's high, so we would have got into the trade at that point over there. Now you will know that that is a fairly dangerous thing to do on a Friday. You have to be careful. Fridays, similar to Mondays, can be a little bit difficult. The advantage of Fridays over Mondays is that, of course, you have the week behind you, so you can see what has actually been happening. Mondays, you can't see what happened over the weekend, of course, so Mondays are more dangerous. But Fridays, you have to be a little bit careful of jumping into a trade on a Friday, particularly if it is in a situation such as happened last week. We had a really strong move up, as you can see. Let's zoom even further in. There we go. We had a really strong move up from this potential trough over here, and price almost came up to the FLD, and so I was reluctant to jump into the trade on the Friday. I could have set my entry level at the level of Thursday's high, but I chose not to, because this is a very major trough that the market is heading towards. It's an 18-month at least cycle trough, and we had seen we'd seen 2.5 days of upwards movement. And so to jump into this long trade would have been a little bit foolish, in my opinion, a little bit impulsive. Of course, we have to be quick getting into the market, but when you've got such an important trough forming in the markets, you must be careful of jumping in too soon. It's obviously it's a fine line that we have to tread. If this was a 40-day cycle trough, as potentially it is in the euro to US dollar, then I would have no hesitation with jumping in. But as it is such a big trough that we're expecting to form in the markets, I thought I would let the markets have a little bit of breathing space. As you can see, the markets moved up and got into a position where the bar on Friday was straddling the FLD. All right, so potentially we might be seeing another GH trading opportunity, or a GH interaction between price and FLD forming. It's also possible, of course, that price has formed that 18-month cycle trough and it's simply taking a breather. Of course it will take breathers constantly, because we're expecting a 5-day cycle trough, a 10-day cycle trough, and so on. So how do we trade this situation? Well, what I am going to do is I'm going to set an entry level at the high of Friday. If price continues its move upwards and breaks through the high on Friday, then I will get into what I believe will probably be an A category long trade. If, on the other hand, price comes back down towards the FLD, then I will consider later in the week potentially entering into a short H category trade, but we must give the market room to form the natural cycle troughs that it will do. Even after forming a major cycle trough such as the 18-month cycle trough, all the other cycles are still moving, of course, and so we must expect a 5-day, a 10-day, a 20-day cycle trough to form in the market. So we mustn't be foolish and jump into another short trade just because the British pound US dollar has been moving down for a long time. So the best thing, in my opinion, as the market is forming such an important trough, is to play a little bit cautious, and I will enter into a long trade at the level of Friday's high. I won't enter into a short trade at this time because I'm going to give the market a little bit of room, and it's got quite a lot of playing space, as you can see. The market can play around in this space all week without actually showing its hand and revealing what is really happening in this market. I'd be happy to enter into an A category trade at the level of Friday's high, because our crossing point, of course, occurred between Thursday and Friday. So our crossing point is over here. There's our crossing point. There's my entry point up there. and here's my initial stop loss right down here. So my entry price is not much above my crossing price. So this is not a situation such as the situation that we saw in the euro to US dollar, where our entry price was so far removed from the crossing price that it rendered the trading opportunity null and void. So that's what's happening in the British pound to US dollar at the moment. Thank you very much for joining me in the Hurst trading room today on the 18th of March 2013. As always, if you have any questions or comments, please pop them into the comment box below this video. And I look forward to seeing you next week in the Hurst trading room. And of course, I wish you profitable trading.